countries. We launched this project in 2015, and today, every month, we have 1,000 new investment application from entrepreneurs which lives in 55 countries. The new part of our ecosystem is our seed fund, Network VC. It has two strategies. The first is to finance our pre-acceleration program. I will tell you a little bit later about it. And the second is to act as a lead investor in our Silicon Valley Syndicate Club. What we do in our club, we are looking for the best startup in Silicon Valley, invest ourselves as a lead investor, and invite business angels from different countries to join our syndicate because they don't have access to startups which are located here. So if you are a business angel, you are welcome to join our syndicate club. If you are network VC, if you are venture capital firm, you're also invited because we share with you management fee in carry if you bring a good deal in our club. Additionally, we have a special platform where we launch educational and acceleration online programs. And this year, we have a special program for those startups who are going to apply for top US accelerators. So if you are one of them, please apply to our program. We invest 50K in startups today. Additionally, we also work with corporations and help them to implement the best innovative solution from all over the world. And in many countries and many cities, we are looking for business partners. So if you are from another city and you want to be our partner, please tell us about it. So before we start, just let's introduce yourself. Yeah. So just a little bit about who you are, what you do.
Sure. My name is Juan. I'm director at Draper University, which is a pre-accelerator for startups from all over the world. And I'm an early stage investor with Draper U Ventures. We look for entrepreneurs and super early ideas. We invest in teams. Okay, can you hear me? We invest in great teams from all over the world. So we're pretty active, and we launched that about a year ago. So would love to connect with anyone that has great ideas.
Hi, I'm currently an investor at Fusion Fund. It's an early stage fund in Palo Alto, and we do seed and Series A investments in companies where tech is the main differentiator to the business model. So anything around AI, machine learning applications, the industrial IoT space, networking, and healthcare are areas of our focus. And prior to this, I used to work at an angel investment group down in LA.
Hi, my name is Anupam. I'm a partner at a firm called Emergent Ventures. We are a seed stage venture firm focused on intelligent software, which is essentially modern, smarter enterprise software, which is going, as you know, deeper across a number of industry functions or industry verticals. We come in at the pre-seed and seed stage. We lead rounds, and we help companies get to the next milestones faster. Work closely with them on refining product market fit, go-to-market, and so on.
I'm Nunu. I'm a managing partner and founder at Strive Capital. We actually are probably the first quant VC fund in Silicon Valley, having started in 2010 doing our investments. First fund very focused on consumer mobile, right now focused around consumer and consumer software, so investments that you probably would have heard about, Gusto, Rubrik, companies like KeepSafe, App Annie, many of you I'm sure have heard. I am also a venture partner at Christian Robotics. We mostly do things around the physical world, which is a little bit odd. So we invest in companies like Zipline, Starship, Spin, and others. And we're really more focused on Series A and Series B there. And at Strive, I'm really more focused on the seed and A space. I've also done some angel investing, shockingly enough, after I was a venture capitalist, which is really interesting. So happy to talk about that as well.
Hey guys, I'm Oscar. I'm with a $100 million US-based fund called Sinai Ventures, primarily seed and Series A, split between New York, LA, and SF, but really investing anywhere in the US. Industry agnostic, so pretty much everything you guys are working on falls under us. So if you're working on something cool, I'm excited to hear about it.
Hey everybody. I don't know if my is
Yeah, it's working.
it's working? Okay, cool. I'm Allison. I work with Blue Run Ventures as an investor. Blue Run typically leads Series A deals and follows on pro rata and all subsequent financing. We focus on companies that are using technology to push their industries forward. So a few examples were PayPal and Waze, Cabbage and Coupa were a couple of big investments that we've made. I'm particularly focused on machine learning and deep learning applications across enterprise and health.
Thank you. It's working. Good. So the topic of our today's discussion is early stage investments for startups and what types and what is the best way to go. So, but I think everybody knows the definitions, and so the possibilities we will be talking about today. It's angel investing, accelerators, crowdfunding, family offices, VCs, but probably mostly about early stages, because most of startups which are presenting here are on the early stage. So my first question is, from your own experience, not from statistics, yeah? You saw a lot of deals, and can you tell me what percentage of angel investing was in that deals? What percentage of crowdfunding or VCs on the very early stages? And so what is the best way for startups where to go, yeah, from this point of view? For example, 80% you saw was angel investing, or it was just 20%. So, and the second question is, what is changing now? Something changed for past years. For example, 10 years ago, yeah, most of early stages were closing by angels, but now accelerators just took the stage, yeah, and they just take the best startups, and for the angels there is no space in this world anymore.
I don't know if there isn't any space for angels anymore. I think what's happened is in early stage we started having a lot more granularity around investments. So you have maybe accelerators that are putting in 50K, 100K, sort of the classic would have been a friends and family round. You have angels, you have super angel rounds, you have micro venture capital funds, right? People like, Softtech now on Cork sort of named that space. You have the guys who are coming in now. We now start hearing about post-seed. We start hearing about pre-A, which is very confusing, right? Post-seed, pre-A, and then A. I think it's very clear that the dimension of the rounds has increased, right? So seed is the new A is the new B, and I think that's very obvious in the market. Back to your question, and I'm not sure I fully understood it. Most of the deals we see have had angel investment of some sort when they come to a venture capital round. Actually, in hard tech, it's very, very common there's been crowdfunding. I think it's really more of a horses for courses type thing, because people want to use crowdfunding for non-dilutive production of materials and products. We can talk a little bit more about, at least my views, and the rest of the panel would be interested in hearing as well, on the views on what crowdfunding really serves well. I think for hard tech plays that makes a lot of sense, because I put it out there in Indiegogo or in Kickstarter. It's non-dilutive to my cap table. I can actually experiment with it and really go through the pains of doing it. I've seen companies that have actually raised money in venture capital, even tens of millions, still doing Kickstarters in Indiegogo. So it's an interesting process. I don't think it really is replacing fully the stack. And in hard tech, as I said, we see a lot of companies doing this. So at least that's my 10 cents on the question.
Okay, thank you.
I think there's a range of sectors that lend themselves to crowdfunding and angel funding more than others, and some don't lend themselves as well. So in my experience, crowdfunding and angel funding tend to work better where the end investors can actually personally empathize with the need. They understand the need, so they tend to be more consumer-oriented products, or products that you read about in the press. In our sector, which is more deeper enterprise software, we don't see actually a lot of crowdfunding, and we do see companies that are angel funded, but those tend to be the friends and family, or angels that are coming in alongside folks like us. In fact, we have a program where we invest and then we have a bunch of folks that co-invest with us. And I think so that's one dimension to parse it, is if your product is something that would appeal to a certain category of people as individuals, that tends to lend itself better to crowdfunding. Just within our portfolio, I'll give you examples. We have a company that does continuous delivery of software, so it's like automated delivery of software. And if I were to put it on a crowdfunding platform, I don't know how many people would really understand if they go deeper what they actually do. I'm not sure I understand properly what they do. So, and then I have a company, which does automation for call centers, and this is basically everyone has had that need of, they call 800 number, and they have a horrible experience, and they're like, why is no one listening to this, right? And they have these bots which are helping bring this feedback into improving customer service. So that kind of thing would lend itself much better to crowdfunding or angel funding. So I think there's that continuum.
I think we're seeing, it's 2019, right? A lot of the companies that have gone public now have been around for about 5, 6, 7, 8 years. So you also have this large population of of wealthy startup founders and like ex-Googlers, ex-Facebookers who have money that they want to invest. And so I think the supply of angel capital has increased over time. I think the majority of companies that I see are angel funded, and a lot of the motivation to go to an angel is less about the hard cash and more about the expertise that they bring to the business. Often I meet entrepreneurs who say the angel investors I work with are my go-to. They have been so heavily invested in the formation of my business. So I think that's what has catalyzed in some, and then also I meet a lot of founders who have bootstrapped their companies because they're, ex-tech people. And so that's been a catalyst for pushing just the overall round sizes and valuations up, because now you have companies or you have people that have either bootstrapped their companies and have been able to build out certain elements of their tech stacks on their own. So they go to venture institutions and are now able to be valued at a higher valuation. On crowdfunding, I haven't seen any companies personally that have been crowdfunded, but I think, again, the challenges with crowdfunding is that you have to be able, as I think you just said, you have to be able to digitally promote your campaign, and you have to be able to describe the value proposition and get people comfortable around why they should invest in your business and the projections, your business projections within a few digital slides, and there's not as much stuff that's lower touch. So it can be harder for businesses that have complicated technologies, especially a lot of IP around the tech that they're building, to communicate. And then another risk with crowdfunding is that I talk to a lot of founders who care about investors' ability to follow on. If they're building a company and they need to get, they need the initial funding to get to market, but then there's other elements of their product roadmap that they need to execute on, crowdfunding is not the most efficient way of going about that.
If we're talking about crowdfunding in sort of the Kickstarter, Indiegogo sense, I think it's a great way to try and find product market fit without taking outside capital first. So if you look at the top 10 list on Kickstarter, some really great products, basically pre-selling millions of dollars of consumer goods. But if you get away from that, you just sort of scroll down through page 10, right? You see a lot of folks who think they have a great idea, often consumer products, and nobody wants to pay for them. So those people save themselves the hassle of raising angel, trying to build the product, trying to market the product, and trying to sell it. They could go on and just see, is there interest today in buying this? Even if we aren't able to produce it for another 6 months, is there interest today in buying this? From the crowdfunding sense of actually raising equity funds from a broad base of small LPs, I think that can be very risky. It can be a turnoff to larger institutional investors down the road, to have messy cap tables, to have sold a significant portion of your equity very early on in the business, which I think is what happens when you're going through that process. I'm happy when I see consumer companies that can show me, hey, we have 1 million people or $1 million worth of sales pre-sold, and now we want to raise institutional venture or angel capital in order to build the product. I'm less enthusiastic when I see somebody who's sold part of the company to a whole lot of people who may not fully understand the business, but because it's $100 or $1,000 check to them, it's less important. There's not quite that same level of diligence. So I think it depends on what part of crowdfunding we're really talking about.
Yeah, to that point, I don't know if this was part of the conversation, but I think to solve that, you also have syndicates, angel syndicates, which I think are an excellent way to just have that one person on the cap table. Yet you get hundreds of investors behind you with different expertise, right, that are just as, not maybe just as committed, but they do have some sort of, I guess, skin in the game with you and are willing to help you. So you open up this network. And I'm part of a few syndicates, and you probably know the top ones. Maybe Jason Calacanis is a very good example of that, the companies that have gone through there, and the network that starts out of those type of investments. From our end, we do, back to your point, which is almost pre-seed, almost before angel investors. So we're usually the very first investors in our entrepreneurs. But the reason we are that is because we get to live with our founders for 5 weeks and really get to know them as people. So we're just betting solely on the person almost. And then we open up a network. We bring in, angel investors and VCs, and I think a few of you have actually visited, our place there. And we open up networks, and then sometimes angels co-invest with us. But I think angel syndicates are a really excellent way to get a huge network and avoid the equity crowdfunding model if that's not something you're comfortable with.
Yeah, I think so. We focus primarily on seed and Series A investments in the enterprise space, and primarily I guess we haven't really seen a lot of crowdfunding going on. But what I have seen a lot recently is, to Allison's point, there have been a lot of companies that are IPOing, and there are a lot of employees who their stock is vested. So I have seen a lot of angel investors coming out of there, and a lot of companies that I've seen recently are also starting to bootstrap. So I think that's been one of the major trends that I've been seeing, at least in the areas of focus that we have. I think everyone else has pretty much echoed a lot of the important points. So,
Can I sling a question to Juan? Do you mind?
Yes, of course.
So you're part of an angel syndicate.
Yeah.
Do you think that there's do you think that it is beneficial to the company going through a syndicate versus going through, say, a very small group of angels who are working together, or even just one or two separate angels in terms of the diligence process? I mean, on one side, if it's syndicated out, they kind of answer the questions once, right? And then everybody can read the write-up. But on the other side, you as part of the syndicate aren't necessarily asking the questions directly to the founders. You're not necessarily getting to know them at the same level. How do you think that plays in terms of helpful or harmful for the startups themselves?
Yeah, I think a lot of it depends on the company itself and what they actually need. The reason I like the angel syndicate model, based on what I've seen, is that you attach yourself, especially for really early investors, or they're wealthy people that are trying to start investing in startups. You attach yourself to a big brand, and the only thing that I can think of right now is Jason Calacanis, and he's investing along with you. So he's got skin in the game. He's done a lot of the due diligence process, and so the other syndicates do the same. So it's really, if you trust the brand, and I think Jason has like 6 or 7 unicorns that he's done the exact same thing with, that he invested as one of the first early stage investors. So I think it's beneficial in that route. I wouldn't just take up any syndicate, right? I think there's a lot of competition right now between different types of funding, right? You can go to angel investors, equity crowdfunding, you go to your seed investors, etc. And because there's more competition, it's up to the entrepreneur to do the most amount of research as to what's a fit for them. So if you're looking for a big network of people to support you in many different ways, then there might be syndicates for that specialize in that. Or, back to your point, smaller angel groups that are hands-on and operational, and that's their full-time role, is to help their companies, as opposed to maybe in a syndicate where they have jobs, they're high net worth individuals, but they don't have as much time. So it's really up to the founder to do their research and exactly what they need. If you just need capital, then you can go one way. If you need more hands-on support, then you can go the other way.
I was a member of Band of Angels for 3 years, and I mean, the due diligence that the band did sometimes was comparable, if not even more significant, than micro venture funds or some of the earlier stage funds. Precisely because of what you're saying, most of the people in the band are semi-retired, or they're focusing mostly on it. Normally there's no main knowledge, so we had a lot of startups that were like, this is tougher. It's like we thought this was going to be easier. But it's good, right? Because at the end of the day, if you have someone like the band or Sandhill Angels or other well-known brands, you know that you've gone through that mark, and that's really helpful for institutional investors as well down the road.
I think these sources are not mutually exclusive. Just for the audience, I think oftentimes the angel syndicates, individual angels, and seed funds, you'd see them coexisting. In most of the rounds that we do, we would come and lead a round. We would have maybe 1 or 2 syndicates then joining in, and we may have a few high net worth individuals that are putting in larger checks coming in directly as well. So it's a combination in many cases that we see. I don't know if you see a lot of syndicates leading rounds, for instance, these days, or?
No, I mean, from my experience, it's only been, with Jason himself. On our end, we usually find angel investors, part of our network, to go into our pre-seed deals. And we've done a few of those deals like that, and it's because of the network. So they're not mutually exclusive. We do stuff with angels, we do stuff with syndicates. I think what's really interesting about our side of things is that, and I think this might be a little different, is we have a huge ecosystem. So we have our pre-seed fund, then we have a seed stage fund, we also have an accelerator, and then we have 24 venture capital firms all over the world that specialize in different things from Series A onward. So we try to, catch people really early and help entrepreneurs at a really early level, and then hopefully try to funnel them through the entire process and keep them as part of the family, per se. But
Okay, thank you. And another question. Maybe some of you have experience with, I would say, crowd investing platform like Seed Invest or Angel List, or maybe your startup had the experience. Can you tell a little bit about that experience? Anybody?
I haven't heard any great magical stories of people raising from these platforms. Obviously we know there are syndicates out there that are very active on Angel List, etc. But there's normally an anchor person or an anchor group of people that sort of see the deal. So sometimes they've actually seen the deal before it's even listed on Angel List, and they're the proponents of it. So I think there's a little bit of that. But I think there's a bigger effect. I think you were alluding to it earlier, which is in crowd investing, unless it's really clean, and Angel List is actually relatively clean, to be honest, on how they manage syndicates. Unless it's really clean, you'll have issues with institutional investors down the road. I have some doubts. I've been an angel investor. I have some doubts that angel investors really create that much value beyond the financing that they put at the table. It's the half-life of an angel investor, I think, is actually shorter than that of a venture capitalist. For a variety of structural reasons, I can go into that. There's exceptions to the rule. We all know them. There are incredible angel investors that have helped companies go through hell and back and stayed with them and even been on boards well beyond anything that would be reasonable. But I think at the end of the day, there's one thing we need to acknowledge, which is the Startup Act and what it allowed people to invest and come back and redeploy their capital into private deals, etc., I think is a wonderful thing. But it's still a very small portion of what we assume to be big retail in terms of investment. And we always forget this really basic thing. That's why we have public markets, right? And public markets are retail driven. They are highly liquid, not illiquid. The information available is much more significant, and there are rules and regulations around them. And so in some ways, I think, again, horses for courses, it's great that we have syndicates, it's great that we structure these things. I think these pieces of the ecosystem, also to your point, coexist, right? Everyone says, oh, crowdfunding is going to kill VCs. Unlikely, right? Angels are going to kill VCs. We've been talking about it for a long time. I always say is actually the activity by angel investors one of the best things that happened to VC funds, right? Because it enabled something that people forget, which is the logic of cherry picking, right? If I'm a Series A investor, I can just watch, right? Because there's more capital before me, I take less risk. And the reality is, what I'm seeing is people are taking less and less risk along the way because they don't need to take it. There's more capital before. So in some ways, again, all of this stuff, there's nothing wrong about it. If you're an angel investor like Jason was in things like Uber, etc., you make ridiculous returns, which is amazing. But the odds that you'll make amazing returns as an angel are very, very slim. And so I think we're just discussing different things that coexist and have been great for entrepreneurs in some ways. But entrepreneurs also have to acknowledge that even though you may have raised 3 million, even 4 million before you get to a real institutional investor at the table, you still have to go through that hump. And sometimes you die there, right? You just die there. And it's very unfortunate, but you do, right? So again, horses for courses, understanding of what this means, and it's not a free lunch at the end of the day. At some point you need to raise more capital, and the basic sources are still there. It's still the same.
I like what you said about angels benefiting VCs. I think angels actually become VCs. I was at the AngelList Confidential event last week up in SF, and they had a panel going of angels who are now managing either large syndicates on AngelList or were starting their own funds, right? And part of the conversation was, sort of, how did you get there and why are you doing this? And I think the common thread throughout everybody's response was, first I started for investing for myself. And then I took a couple friends' money, and then I realized I should be charging them, and I should be getting carry. And then I had enough of them, and I realized, well, I should also be taking management fees. And then before they knew it, they had a fund. So I think that the good ones, or maybe the ambitious ones, or the ones that want to make a career out of angel investing, end up doing what we're doing. So I think it plays very nicely together.
Some of the top early stage funds, Floodgate came out of Mike putting some of his capital to deploy. Softtech, Uncork, with Jeff doing the same. So I think that's absolutely natural. It's amazing that happens. But it does acknowledge the fact that they need to be something else. They can't just be angels, which is back to my point. Structurally, I don't think things change that much. You just have added players in the market, effectively.
Okay, thank you. I know that this word is almost forbidden now, but do you believe in the second life of ICO?
Is that STOs, the second life of ICOs? Giving too much of a share in the company very early on, doing price rounds, when maybe you shouldn't be thinking about price rounds and you should be thinking about safe notes or convertible notes or other mechanisms. Trying to create very complex structures with founders preferred when they're starting. Why, right? I mean, the company's just starting. Anything that relates to giving certain rights to investors that probably shouldn't be given, like very aggressive redemption rights, so the ability for an investor at a certain point in time to say, by the way, I want my money back plus interest, right? With sometimes very short timelines, giving liquidation preferences that are just silly, like in terms of the classic 1x argument between it's participating, non-participating. I have actually a strong view on that. But people like giving 2x participating preferences and stuff like that, giving special rights to people to stay on the board forever and ever, et cetera, et cetera. I mean, I've seen all sorts of things. I've even seen it in entrepreneurs that allowed VCs to come in with those rules, in particular in non-classic markets, so not US, not China, et cetera, where markets are a little bit more nascent, where you see some of the local VCs getting in with stuff that is just absurd. With VCs, I'm a little bit more positive because what ends up happening is if the company does have a route forward, in this case, for example, the case I'm mentioning, they got a very top tier European VC to come and lead the Series A, and they looked at the document and said, this is not okay, right? These redemption rights need to go. You guys can't have a 2x liquidation preference that's participating. And unless you guys clean that up, we're not coming in, right? So you need to be at pari passu, so you need to be all aligned, same part of the waterfall, et cetera. And obviously the investor that was there before realized this is only going to get done if we change the rules, so we do. So there's still mechanisms to recover sometimes from mistakes that you do early on, but having the right type of advice, not only for your legal counsel, but maybe, as you said, some advisors or some, willing angel investors that help you with that say you shouldn't really allow them to get away with that. I think it's important, but it's a little bit of a juggling act. You need capital, right? So you sometimes do need to give away some stuff. My message is, down the road you might be able to get away with it unless it's something really ridiculous.
Okay, somebody else?
Yeah, so along those lines, being careful about the cap table early on and not having, dead weight on that. I've seen all kinds of cap tables where there was someone that had promised a company something and they had 30% of the equity or 20% of the equity for promising something, and they're sitting on the cap table, right? That really makes institutional funding really hard. All kinds of, I've seen back in the day, I got into venture maybe a dozen years back, I've seen 5x liquidation preference, believe it or not, on something, right? Where do you go with that? But coming down more to more tactical things at fundraising time, right? I think it's there's a lot of art and science in the amount you raise, and then also in the beginning, more and more entrepreneurs are trying to say, okay, this is my terms, even when they're going to VCs. So it's a fine balance when you do that, right? Typically, with a institutional investor, I'm starting to see more pitches where people are presenting desired valuation. So there's a pros and cons of that. But in terms of the amount of financing, I think that's another one which you have to think about carefully. Especially, you can also tailor it based on who you're talking to. But the last thing you should do is base it entirely based on how much you need to get to something, because that's just one of the inputs. You may need 100 million to build a rocket to get to the moon, or maybe 500 million, but that's not your seed check size. So you have to really fit your milestones into who you're talking to, or how you think is a rational way to get your company funded. Couple of inputs.
To the other side of exactly what you said, there's also stuff you can do that seems really non-obvious, right? Which is, I should get away with the highest possible valuation I can. Not necessarily the right thing, because the amount of funding you're getting and your valuation is what I call baggage. You're carrying it, right? Now, you're not attaining that valuation probably today, so it's a forward valuation, right? Because it's based on something that you might or might not attain. But at some point, you're going to have to pay for it. Hint, we company, right? So we're seeing that right now in a very public aspect of the business. So at some point you're going to have to pay for this. If your valuation is very high, with your liquidation preferences into it, like you have a lot of capital in, it's going to be more difficult for you to have a successful exit. So you should be actually relatively lean in how you manage your assets and resources. It doesn't mean you shouldn't be raising. You should always be raising. But you have to be very, very cautious that you're not just jumping tremendously on your valuation, the amount of money you're raising, because at the end of the day, the first guys who get screwed is you. The founders get screwed first, right? Because they're common, et cetera, unless magically you do a secondary and you sell 700 million of your stock. But basically, founders get screwed, right? And the investors might not make much money, but they have preference, and it's life, right? And that's how things work. So again, I see people like, I'm going to go for a ridiculous valuation, I'm going to raise a ton of money up front, and all of a sudden you're carrying that, and you will have to attain that valuation at some point in time. This is not magical. The beautiful thing I think about now, a lot of people ask me, is this a bubble or not? The great positive thing I think of what's happening right now is public markets have actually stayed relatively rational. At some point you're going to pay, right? Retail investors, institutional investors are going to make you pay in public markets, right? I think we've seen that with all the IPOs over the last year and a half, in particular in tech.
Thank you very much, guys. So maybe our guest, yes. A lot of questions.
Yeah, hi. Question to Anupam. You spoke about the seed check size. So what should be a normal seed check size? And the another to rest of you is the angels or the earliest investments, are they open for international founders not based in US?
Yeah, so on the check size, again, there is probably a lot more art to it than science. There's no obviously fixed number, right? You'll see some of these announcements talking about 5 million, 10 million, $20 million seeds, but believe me, those are really a very small minority. I'd say typical sizes today probably anywhere from 1 to 2.5 million, and it that's a full spectrum these days, right? Pre-seed to post-seed and pre-A and all of those things. Everything could be called as seed, right? So it's really about what are your, obviously what sector you are in, what proof points you have, what does your team look like, what have you done in terms of previous financing, do you have a product out, do you have revenues, do you have momentum, right? A lot of those things will determine, because your, the amount you're raising is very tightly linked to your valuation in a certain way. So when you say I'm raising $5 million, you're essentially saying that my valuation is going to be at least $25 million, because you're not going to dilute more than 20-25%. So, and on the other hand, if you're going for too low of a number, then your valuation, so you're signaling on the valuation with the round size. So you have to keep that in mind as well. So I think it's really very closely tied to the sector and then where you are in terms of the development of the company.
So in 2010, average amount of money raised pre-A was 1.8 million in the Bay Area. 2018 was 5.4 million pre-A. So what's basically happened is people like us, we were doing deals of 1.5 million seed, right? And where the person would put 700K, a million in would be the lead. And right now, I think we're seeing 2-3 million. I would agree 5-10 million are still the exception rather than the rule, but we seem to be moving a little bit to the higher level of the 3 million there.
And I would again say, some of those companies are actually more well developed than the $1 million seed a while back.
Agreed.
And also that
Agreed.
5.4 million is happening in my experience across, the seed is getting more and more diffused with the safe agreements. There used to be that, okay, now this is a seed round and now this is 2 years later, I'm ready for Series A. We're seeing many companies, including in our portfolio, we would put in a pre-seed check and they maybe raise 4 tranches, including 3 from us by the time they get to Series A. And this is 3 months later, they hit some milestone, here's 500K more. Right, and or someone else comes in and says, hey, your safe valuation cap is maybe up by 20% from last one, just 3 months back. So we're seeing that sort of getting diffused over a spectrum versus sort of one sort of very defined seed round. But of course, there's very well-defined seed rounds that happen as well, and definitely seeing some of those $3, $5, $7 million seed rounds. But I would still say those are off the total universe, relatively smaller, especially as you go above 4 or something. But definitely seeing a lot more $2.5, $3 million type seed rounds, $4 million seed rounds.
I have one question.
The international founder question. So.
Investing in international founders? Yes. I've invested in companies in US, China, Europe, Japan, Korea. I've been on boards of companies around the world, so I invest internationally. I think there needs to be a dimension to the business that amplifies for exit, right? I think we were having, Alex, the discussion earlier, which is if you invest very locally and the ecosystem is not there for M&A and IPOs, et cetera, you're bottlenecked at the end, right? So basically the company needs to become something bigger than the space that it's on. One of the top performers in our portfolio in Fund 1 is App Annie, and everyone now thinks App Annie is a San Francisco company because rightfully so, their headquarters right now is San Francisco. We invested, they were a Beijing company, right? And the CEO is a French guy in Beijing. I mean, the odds that guy could be successful is like, good luck with that. I know maybe 5 guys who did this, right? Fritz Demopoulos at Chunar and a few others, right? And he pulled it off. And Sequoia, actually, interestingly enough, led the Series C out of here, not out of China. And they were still a Chinese company, right? The cool thing about App Annie is they started selling a lot in North America and in the US very early on. So they had a business here, effectively, at the end of the day. So I think that's the fundamental of the question. Do you have a business somewhere else in the world? Raising from the Bay Area, not having a business here, I think is very difficult. Do you have a story about the US if you're raising from the Bay Area or not? But then, for sure, there are businesses that do really well. Our first big investment that IPO'd very, very quickly was a Japanese company. They only focused on Japan. They IPO'd in Japan. Amazing return, right? But it's a market that had liquidity. It's a market that had a way to go out and to have an exit.
Yeah, hi. Recently, we are seeing rise of corporate VCs. So what do you think, what effect, positive or negative, it will have on institutional VCs?
My perspective is relatively positive. There are bad behaviors. We've seen some strategic investors do really nasty stuff and get, again, the wrong rights going into a deal. But for the most, we see either a neutral effect of strategic partners into investments or sometimes actually positive, right? Because they do go the extra mile to bring it back. There are very good corporate venture capital arms. There are a lot of not great corporate venture capital arms who are slow like hell, et cetera, et cetera. But there is, I think, at least neutral to a little bit of value. You need to be very careful again with the rights, right? What are you giving them away? What reporting rights you're giving away, et cetera? Because you can get stuck between a rock and a hard place. Your corporate venture capital arm or an off-balance sheet investment out of a public company that's somewhere else in the world that has very specific requirements, like Japanese companies, for example, have very different requirements in terms of reporting. That's a bit nasty because then you need to spend a lot of time just for that specific investor and doing a lot of reporting, etc. But I've seen, I'll throw one out because everyone will ask me, who are the good corporate VCs? I'd say Sapphire is a really good corporate venture capital fund. And they had a very interesting mission on how they developed. And they're now a lot more open on how they did things. They were originally SAP Ventures. But I think they're an amazing enterprise software investor, right? There's the ability that they've had. Scale Venture Partners came out of Bank of America. It was actually a corporate venture capital arm, and they're one of the top investors mid-stage in enterprise software as well. So I think there's really good examples of strong corporate venture capital arms.
Prior to working at Sinai Ventures, I was with BMW's VCR. And they're great, and I think they deserve to be on your list of top
iVentures.
CVCs.
Is
Yes.
it still called iVentures?
Yes,
Very
yes.
good.
But, and this is, BMW aside, which is an exception, and the firms you mentioned, which are exceptions, I think founders need to be very careful because CVCs can promise certain things that may seem amazing that institutional investors could never promise, right? Contracts and sales and partnerships and MOUs and all of this. But the investors are always different from the business units. And the investors always need buy-in from the business units. And so they can talk the business units into agreeing to something, invest because of that, and then the business unit may wake up next week and realize, yeah, what did I do here? The business unit backs out, but the investor doesn't mind because they're already in. And the business unit doesn't matter because they're not actually part of the investment. And you're stuck holding this promise that nobody is actually going to fulfill. So you just need to be very careful to understand exactly what's being promised, what's not being promised, who's promising, who's going to pay if somebody backs out. There are more complications with CVCs, generally speaking, as a group than with institutional investors. There's also a lot of potential strategic advantage. I mean, there's examples of companies that wouldn't be where they are today without without corporate backers if they'd gone the institutional route. So you just have to be extra careful, I would say.
There's some rules of thumb when working with corporate investors. I think there's certain areas where it really works out well, and I think one thing is what I've seen, and my prior fund had corporate backers, is I think it works better towards mid to late stages,
Yep.
right? So I think if you're taking seed money from one corporation, that can be really risky,
Yep.
because your company itself could be pivoting a lot, so you don't want to be tied very closely with the future of one company. And also, as a seed funded company which may have 5 or 10 employees, you're really too small to engage with these large corporations and navigate the whole bureaucracy and hierarchy and really tie yourself to their future. Versus once you have raised, let's say, Series A or B round, you have $10, $20 million in the bank, you can have a couple of people in the organization whose full-time role is to just chase people within this large company. So I think where it works really well is when you have some financial investors that are really there who can back you for the long haul, do your pro rata follow-ons or do rounds in case if needed, right? And you have some corporate backers that come in as sort of follow-on investors in sort of the later rounds. I think there it sort of works well. And another rule of thumb which we talk with our portfolio companies is 2 is always better than 1. Especially if you're having to negotiate some strategic rights. I mean, rule 1 is never actually give any strategic rights, have very clean financial terms, right? No ROFRs, ROFUNs, ROFOs, ideally. But if you had things like that you're negotiating, then having 2 or more corporate backers, again, this is Series B or beyond rounds, that can work really well. From entrepreneur's perspective, you can get 2 or 3 of them and sort of balance out that.
You can even play them against each other almost a little bit, right? With the board.
That could help with M&A, things of that nature as well down the road. If you have,
I think it's very well said. I completely agree with you.
One more question? Last question. Last question.
Hi, as a founder raising a pre-seed round, and by pre-seed I mean pre-launch, we're raising in a safe, and we're going through very tough and long negotiations for the cap in that safe. What's your advice on managing that negotiation? Should we just decide the price and shop around, or wait until we finalize with at least one investor and agree on a cap, and then go to the other investors? What's your advice on that?
The latter. So you need, if you have it's not really a lead, so to speak, in a safe, but if you have a significant investor, I don't know how much you're raising, but let's say you're raising 500K and you have someone who's willing to put, 100, 200K at the table, which is a significant investor. Having that discussion and agreeing on a cap, I think makes a lot of sense, and then going around and bringing the rest into the fold. I've been an angel investor and I abide by whoever is the largest investor, right? I don't go there and it's like, oh, but I'm a VC on this side, so let me negotiate this. No, I come in, I write the check, and it's basically done, right? Either I'm okay with the rules of the game or I'm not. I think to your point, the pre-launch thing is actually, there's something interesting about it. it's difficult to actually raise money pre-launch. It's getting more and more difficult. You were making this point, which is a really good one, about people are further ahead sometimes in the stages that they are today in terms of their fundraising. And the reason for that is actually not magical. It's just the cost of development comes down, right? The cost of developing software for consumers has come down dramatically with mobile. The cost of developing hardware has actually come down quite dramatically as well, maybe not in the same order of magnitude. And what that means is the expectations of investors, shockingly enough, even angel investors or super angel investors, is that you will have achieved a lot more with a lot less capital. I'll give you a really stupid example. I met with a team. This guy had actually an interesting exit. I would say a small exit, maybe around $10 million, right? Previous company, but they made a lot of money. They hadn't raised a lot of money, so again, good news for them. They decided to reinvest part of the money into the new company. They put $250K to work over the period of 9 months. And what these guys achieved in 9 months by being really intelligent, 2 founders here, one of their teams was in Eastern Europe, right? They developed something that I was like, I've seen guys with, 5 million in 3 years that didn't achieve that. Now that's impressive. And I'm an institutional investor, I'll talk to those guys any time of the day, right? And those guys will leapfrog rounds because I don't care. If they're further ahead and they've just taken $250K to get there, I'll consider it. So again, difficult to raise pre-launch. I would wait for a sort of big investor to come on board. But at the end of the day, if you get the cash, just run with it, man. Just take it. Unless it's some ridiculous conditions at the table, 5x liquidation preferences and stuff. But I would definitely take it.